Two women in Columbus, Ohio, both 32 years old, both earning $68,000 a year, both hit $10,000 in savings during the same month. Both felt that identical rush of pride. Woman A keeps hers in a Chase savings account, checks the balance occasionally, feels safe. Woman B moves $4,000 into a Fidelity brokerage account, buys a total market index fund, sets up a $200 monthly auto transfer, forgets about it. 20 years later, Woman A has $11,200. Woman B is sitting on $198,000. Same city, same salary, same starting point. The only difference was what they did the month after hitting $10,000. And this isn't one person's story. The data says most Americans are making this exact choice right now. A 2024 Bankrate survey found 56% of Americans can't cover a $1,000 emergency. Among those who have saved, the Federal Reserve reports the median household holds $8,000 in bank accounts, but only $5,300 in retirement accounts. People save into cash far more than they invest. And the Bureau of Labor Statistics reports inflation averaged 3.1% over the past decade. That $10,000 in a 0.45% savings account didn't hold its value. It lost $2,650 in purchasing power. You didn't save $10,000. You saved $7,350. There's a name for what's happening here, and once you learn it, you'll see it everywhere. This pattern has a name: the cash trap. It's what happens when disciplined savers accumulate money but never deploy it into anything that actually grows. The balance looks like progress, but inflation erodes every dollar sitting still. Most people never notice because the number on screen doesn't drop. No red, no alarm. Just quiet erosion disguised as safety. Those who build real wealth escaped this early. And it starts with what your savings account is actually doing to your money. According to the FDIC, the national average savings account yields 0.45%. Bureau of Labor Statistics data puts average inflation at 3.1% over the past decade. That gap means every dollar in your savings account loses roughly 2.5% of its purchasing power per year. Picture someone who parked $10,000 in a savings account in 2015. Today, it reads $10,460. But the goods that cost $10,000 then now run $13,600. The account preserved a number while the value shrank. Behavioral economists call this nominal illusion judging money by its face value, not its buying power. The number never drops, so the brain reads safety. But safety and stagnation look identical on a bank statement. $10,000 at 0.45% for 20 years becomes $10,942. Adjust for 3% inflation and real purchasing power drops to $6,060. That's $3,940 lost silently. That same $10,000 in an S&P 500 index fund, averaging 10%, grows to $67,275. Inflation adjusted, $37,300. One path multiplied real wealth 3.7 times. The other destroyed 40%. Your savings account isn't a wealth tool. It's a parking lot, and parking lots charge fees you never see on the statement. But the math is only part of why people stay trapped. The psychology runs even deeper. A 2023 Gallup survey found only 61% of Americans own stocks, down from 67% before 2008. The top reason among non-investors wasn't lack of money. It was fear of losing what they had. That fear makes sense. You saved $10,000 over 18 months of sacrifice skipping dinners, declining trips, brewing coffee at home. Putting that into something that could drop 20% in a single bad month feels like betraying your own effort. So you keep it in cash, not from ignorance, from loss aversion. Kahneman and Tversky proved we feel losses twice as intensely as gains. The math says invest. The gut says protect. Then comes the licensing effect. Hitting a savings milestone creates a subconscious permission slip to spend. Save the $10,000, feel proud, loosen up, watch it drain to $7,000, grind back, repeat. Ramsey Solutions found 79% of self-made millionaires built wealth through employer-sponsored retirement plans, starting at an average age of 29. They didn't wait for a comfortable surplus. They deployed early and automated. They didn't love volatility. They understood the price of avoiding it. And when you zoom out to see what this one decision costs over a full career, the numbers become impossible to ignore. According to J.P. Morgan's Guide to Retirement, an investor starting at 25 needs $4,500 per year to reach $1 million by 65. Start at 35, and that doubles to $9,800. Delay isn't linear, it's exponential. Take that $10,000. Invest it at 30 in a total market index fund averaging 10% annually. By 65, it becomes $281,000. Wait until 35, it reaches $174,000. Wait until 40, $108,000. Same money, only the timing changed. Psychologists call this present bias, overvaluing the comfort of now over the larger reward of later. Your future self feels like a stranger. You sacrifice their wealth for your peace of mind. Every year, a 30-year-old delays investing $10,000. They lose approximately $21,400 in future value. 5 years of delay on one deposit erases $107,000 in retirement wealth. That's based on the S&P 500's historical 10% average across every 35-year rolling period since 1926. Keep that $10,000 in savings until 65, and you'll have $11,500 nominally, roughly $4,200 in real purchasing power. Invest it at 30, and it becomes $281,000. One path turns $10,000 into $4,000. The other turns it into $250,000. So what does escaping the cash trap actually look like in practice? This week, calculate your emergency fund number. Take essential monthly expenses: rent, utilities, groceries, insurance, minimum debt payments, and multiply by 4. That's your floor. Everything above it is trapped capital. If essentials run $2,200 monthly, you need $8,800 for emergencies. The remaining $1,200 is ready to deploy right now. This month, open a brokerage account at Fidelity, Vanguard, or Schwab. 0 minimums, 0 commission trades, 15 minutes. Buy one total market index fund, VTI, FSKAX, or SWTSX, and move your surplus in. This quarter, automate a transfer from checking to brokerage on payday, $150 to $300 monthly based on income. Before you see it, before you budget it. A bill, not a choice. This year, increase that transfer by $50 each quarter. By December, you're investing $200 more per month than January without feeling it. The entire system runs on one principle: automation. Every time you choose to invest manually, loss aversion fights you. When it's automatic, the money moves before fear arrives. Automation doesn't make investing easier. It makes the cash trap structurally impossible. Every month, your surplus sits idle in savings. You're paying an invisible fee that compounds against you. But this was never really about the $10,000. The cash trap isn't a financial mistake. It's an identity mistake. It's the gap between saving and investing. Most people master the first skill, earning and keeping money, but never learn the second, putting it to work. And that gap is where most middle-class financial lives quietly stall. You have two paths. Path A: keep your $10,000 where it is. Watch the balance stay flat. Feel the low-grade comfort of a number that never drops. And 20 years from now, realize that comfort cost you $250,000. Path B: accept that real growth requires your money to leave the parking lot. Deploy your surplus. Automate the process. Let compound interest do what willpower cannot build: wealth while you sleep, while you work, while you forget it's even happening. This isn't about becoming a day trader or timing markets. It's about becoming the kind of person who understands that saving is the foundation, but investing is the house. You already proved you have the discipline. You saved $10,000. Most Americans cannot say that. Now prove you have the vision. Don't let the cash trap turn your greatest financial achievement into your most expensive missed opportunity. Path A is the person who looks responsible. Path B is the person who becomes free. Both saved the same amount. Only one built wealth with it. $1 saved is proof of discipline. $1 invested is proof of vision. Wealth has always belonged to the ones who knew the difference.